highlighted, I underlined assets up. Because there is some argument out there that says that approach is a better approach so that you can grandfather yourself in to those wonderful benefits of a corporation I mentioned earlier. One thing you do have to keep in mind, this comes up a lot. I was talking to him, I have a transaction where I'm representing somebody overseas that says part of the initial diligence is that it would be a tax-free transaction. And this is exactly what we're doing here into a U.S. corp owned by a foreign corporation. If the liabilities, the total liabilities on the balance sheet, exceed the tax basis of the asset, there's gain recognition for all the members. So you have a 1-to-1 ratio, all right? Now, it's complicated. We don't have time to go into that. But again, it's called 357C. It's the code section. This traps a lot of people. This is the very first thing that I look at. I say, okay, well, hang on a minute. Let's make sure we look at this.
Yeah, just again, without diving into too much of the weeds of the code sections, but just to give you an example of where this happens. So, startup company formed as an LLC, 3 founders, taxed as a partnership. Seed investor comes in and invests $1 million on a convertible note basis. They spend all the money, building the business, generate $1 million in losses. Those losses get allocated on the K1, as Brian said, to those individuals. There's 3 owners, because remember the debt investors are not owners, so those losses get allocated to those three individuals. If not done right and thought through, you can have $1 million gain allocated to those guys. Potentially.
Depends on whether it's non-recourse or recourse, but you're exactly right.
So again, the take-home message is, particularly if you're investing in a company that's an LLC and you're doing it as convertible debt, you really ought to make sure they have a good accountant and think that through. Because we've been able to kind of engineer around it, but that's not a fun conversation to have with somebody. Tell them they got $1 million in phantom income gain when they're doing their venture capital deal.
And whether you're cash or accrual basis, there's just a lot of complexity. But this is the hurdle right here. We have to make sure. But I always recommend an assets up approach. I can't recall last time I did an assets over. And boy, form over substance, it gets screwed up a lot. There's a lot of this is one that I'm there's oh shit moments. These are the ones I usually get, the oh shit moments. So keep that one in mind. Yeah. All right.
So we're going to spend the rest of the time here talking about investment structures and term sheets. And in your packet, in addition to these slides, should be a couple of example term sheets. And we're not going to go through these line by line. You guys hear me okay if I'm back here, by the way? John, you okay? Am I projecting enough? All right. But just to give you an example of what's in here. So there's one that's titled, they both say company name at the top, but one says non-binding summary proposed terms for secured convertible promissory note financing. That one is an example term sheet for a seed convertible note investment. Looks a lot like what the Quincy the Angels use to negotiate their terms. Do people have those? I'm getting some confused looks. Okay, all right. And then another one is titled non-binding summary proposed terms for Series A preferred stock financing. This is a little bit of an older document, but it's an example of key terms for a preferred stock investment. And it's got a bunch of notes in there too, and I'm not going to spend much time on this at all, but it's a useful guide, I think, and hope, because it not only has the basic terms, but it has some pretty good discussion about what those are and why you would put them in and sort of what the key negotiation points are. So just as an FYI, those are references, and I'll go back to those here in a minute, but wanted to mention them to you. So the 2 basic ways that angel investors, VCs, invest in a startup are, as you I think already know, convertible debt and preferred stock. So convertible debt is it's technically a loan to the company, and that loan has a maturity date. So it's in some sense just like a bank loan, right? It says here we're going to loan you money. It's going to generate an interest rate of probably between 8 and 10%. It's going to come due in 2 or 3 years. But the theory of it is, if the business goes according to plan, that loan converts into the next round of financing, right? So, and again, I think you guys talked about some of this morning, so I won't hit every one of these. But the basic concept is, if you've got a seed round deal, early stage business, rather than get into a big debate about what's the valuation of the company today and draft a bunch of complicated preferred stock documents that provide for a whole bunch of rights, let's do something that's at least a little bit simpler and say, will do a convertible note, and it will convert into equity when you do your next round of financing. So let's say if you're going to go raise venture capital money of $2 to $4 million or $6 million, $8 million a year or two from now, this note is going to convert into that round of financing. It's going to convert from debt into Series A preferred stock on the same terms, but with a lower price. And the price that it converts into is typically the lower of 20% less than the A round price, or a capped price. And typically, at least in deals in the Midwest and increasingly on the West Coast and East Coast, there is also a cap that's negotiated in the preferred stock term sheet. So if you look at you guys don't need to go there, but I'll point it out. In the term sheet for the promissory note financing, at the bottom of that first page, there's a reference to a valuation cap in all caps. That's one of the key negotiated points in a convertible note deal, because what you're really saying is you're saying, okay, we're gonna defer the discussion. We're not going to say we're going to buy 20% or 30% of your company right now. We're going to defer that conversation, and we're going to say we're going to convert into the A round price when the VCs come in and value your business. But we do want to have some ceiling on that. So, and the theory for that is, without a cap, it creates a little bit of a misalignment between the investors and the founder potentially, and also doesn't maybe properly give credit to the early round investor. Let's say the early round investor invests when this business was nothing, was pre-revenue, puts in $1 million on a convertible note, spends a lot of time with the business, introduces them to a lot of contacts, gives them a lot of advice, helps them build the management team, and that business is wildly successful, and 2 years from now raises $6 million of VC money at a $12 million pre-money valuation. Well, if all you're getting is 20% off that $12 million valuation, you might say, well, hey, I did all this work, I invested when you were nothing. That's not really fair. So typically there is a cap on the valuation put in, and around here I would say the typical, that typically comes in at somewhere between $2 and $3 million in terms of price. Sometimes a little lower, sometimes a little higher, depending on negotiation. Does that make sense, guys? Okay. I mentioned in here, sometimes you'll see an associated warrant. A warrant is just a right to purchase stock or equity in a company. Sometimes, instead of the 20% discount, you will see a warrant issued to the investor.
In lieu.
Correct. In lieu of the 20. And that operates in a similar manner. Basically gives them the right to get more equity in the company. There's some pros and cons that are, frankly, detail points in my view, mostly about which one's better or worse. I think the discount's a little simpler just because it's less paper. You will see a warrant sometimes. You'll also see, in addition to the sort of classic case of, okay, we're going to set this up so that it automatically converts into the next round of venture financing at the lower of 20% discount of the cap. You'll also see some other conversion features. So the investor typically has the option to convert, but is not required to convert if the company does another round of equity financing that's not a, quote, qualified financing. So if they don't raise a certain minimum amount of money from a venture investor, but let's say they just do a $500,000 equity round from friends and family or what have you, that in that case the investor would have the option to convert into that round. In my experience, those rarely. How much time do we have left, Scott? 5 minutes? 10 minutes? Okay. Okay. Thank you. So you'll see that there's also typically an obligation to or an option to convert into equity if the company is sold before the note converts. So let's say, and this has happened actually in some recent deals for us, investors put in $1 million in convertible note financing. Business does well, and a bigger company wants to buy them out early, do kind of what's sometimes called an acqui-hire. And so the company decides to sell and not go do that next venture financing. In that case, the typical structure, and that structure that's reflected in this term sheet, is the investors have basically a couple of different options. One is they can convert into stock of the company at that cap valuation. So whatever you negotiate, if it's $2.5 million pre-money valuation, they can convert and kind of be an equity investor and take whatever their pro rata share of that sale is, or they can decide not to convert and basically get 2 times their money back in the deal. And that's a term that the 2x your money back is something you rarely see on the West Coast, but I'd say it's become a pretty common term in the Midwest in terms of how these seed deals get structured. You also see, and there typically are negotiations around what some of the governance rights are for the investors. So you'll see in this term sheet on the bottom of the second page, there's a description of the board structure. Typically in a seed deal, and certainly in a preferred stock deal, there will be a discussion of who's going to sit on the company's boards. I know for Queen City Angels in particular, that's an important point. Some other seed investors that invest as a convertible note tend to not take as much of a board position, but I know for the Angels and others around here, that's an important piece. So, and the most common structure there would be 1 or 2 founders sit on the board, 1 or 2 investor representatives sit on the board, and typically you'll try to find 1 independent representative that serves on the board that has some independent industry experience and some expertise to bring to bear. But that's typically also part of the negotiation. There are also typically a list of things that the company just can't do without the investor's consent. So the company can't go do a big new round of capital, can't sell the business, can't dramatically change the business plan, things like that, where there's just sort of a blanket, what we call a veto right. And that's a very typical provision. Exactly what goes in there, though, is often subject to negotiation.
You know, I have one thing, too, and you know, what I see, the question is, when do they make the most sense? You know, and
yep.
I think there's 2 places where they make sense, and I'm looking from an entrepreneurs, because we have a few entrepreneurs in here as well. They make sense extremely early stage, you know, a startup, venture funds here in town, and that's how they do those early stage funds. It's a convertible, or to bridge an almost certain series. You know, to bridge, you know, there's emergency cash flow needed to bridge it to its Series B, Series C, whatever it may be, Series A. There's a small window of time where you just have, you're really out of time, and you've got somebody that's already kind of in the deal, and you know, it's sort of emergency. You hope that never happens. But that's where I see it most common. You know, I've had a couple circumstances with some more mature companies. What happens is I don't know, the things start to deteriorate a little bit, and you got 1 or 2 of them where the notes have matured, and you know they want their money back, and
yep.
and you know, investors all have their own sorts of opinions, and then it can get pretty difficult on the entrepreneur or the founder, maybe everyone founder, when those circumstances happen. I've got mixed feelings about them myself. I've done them. I think they make sense in one of those 2 scenarios. Because I think a lot of times what happens is people get kind of lazy, as you mentioned. You just I don't really want to put a lot of effort and time into this, so let's just do it this way. Small amounts of money, probably not that big of a deal, but you know, later on it becomes a bit bigger of a deal.
Yeah, I think the convertible debt has become the standard for seed investment
yep.
Around here, and the one place it doesn't work as well is if you don't do that next round of financing,
right.
because then it doesn't work for